Good evening, everybody. Sound check. As such great confidence in the system, I didn't even do a sound check early. That's code talk for actually, I barely got the slides up in time, so I didn't have time to. Hi, guys. Did you like the email that went out the last two times? It said, it said something like this may, for the last couple of presentations, I put a special note on the email saying, I think this is an exceptional presentation. Today I said, this might be a little boring, to be honest with you. There's a lot of different topics you have to cover as a trader. And when you, if you ever, I haven't been to like a convention type thing. What do they call them? A trader expo. I haven't been there in years. But when I used to go, oh, thank you, San Antonio. When I used to go to those, it always used to crack me up because talking in one room would be a person who was very smart, intelligent, and was talking about the secrets of trading, and it was usually soft topics. And in the other room was the guy selling some snake oil um, indicator, and of course the room with the snake oil indicator was packed, overflowing, and the other guy's talking to an empty room, which I always saw as backwards. But that happens sometimes. In this presentation, is maybe a little bit more of two things. It's a little bit more of what not to do and a little bit of an eye opener of some things you maybe should not be looking at. I'm going to do this almost kind of backwards. We're going to kind of start off with the conclusion first and work backwards from that. How does that sound? So is indecision a huge enemy? I'm not going to say that I kept things short so we get done early, because I think I did, but I always say that and I never seem to finish early. Here's the issue that we need to address. And I'll go right to the little opening slide here, which you probably saw on one of the emails, I think. Here's the issue. And really, as I got more into this, at first it was a topic that I thought was good, and I thought, okay, it's good, but it may be a little boring. As I really got through it, I realized how much this permeates everything that you guys do, and it may actually be a lot better than you think. The issue is, what makes your decision, basically, to take a trade? Now, when I say a trade, if you're new with me, I consider everything trading: long-term, short-term, day trading. If you hold something for a year and a half, that's a long-term trade. So I just use that term. Don't think this is just about day trading. I like long-term trading as well too. The issue comes down to, how do you make your decision to pull the trigger on something? It's kind of a three-step process. First, you have to go out and find, what we call a watch list, a hot list of things that you may potentially do, right? And then you have to decide, okay, the time is getting right to enter this. I call it stalking it. In other words, you've kind of decided that this is the right position and the timing's getting right. And then you have to pull the trigger, right? Does it make sense, everybody? It doesn't really matter if you're day trading or long-term trading. It's kind of a three-step process when you think about it, correct, everyone? If you go through the process, you're thinking, okay, I need a couple things long in my long-term portfolio, right? So you go out and you create a watch list. You get about 15 or 20 things. You say, okay, I like these. And they say, okay, here they are, but I don't really like the entries. I don't like the market timing, whatever it is. And all of a sudden you say, okay, we're getting pretty close now. And you start stalking something. And then comes the day, comes the moment, comes the second. And I don't care if you're taking a trade you intend to hold for a year. There becomes a second where you have to decide, yes, this is it right now, right? And as a day trader, the same thing. You come with a list of stocks at the beginning of the day. As the day starts to wear on, you find something you like for that right moment. And no matter how careful you are, no matter how much you have rules set up, no matter what you decide, there comes an exact second where you have to push that button and say, now's the time. Does everybody agree with that? I've said nothing that anybody could object to. Does everybody agree? Or at least understand what I've said so far? Because make sense what I've said? Yes? I don't think there's anything you can disagree with. It's just facts, right? Because what today is focused on then is this simply, only Mark's out there, is what makes you push that button? What is it that makes you say, yes, now, time to go right now? What is it that makes that decision for you? And is it something that you could defend, for lack of a better term? In other words, is it reproducible? Is it something that later on you could say, yeah, I did the right thing? Or is it something that just kind of like, well, seemed right at the time, I don't really know, right? So let's move on and start to look at a couple of these things. You can read the slide here. Well, actually, I have some good points. Indecision comes from a lack of confidence, right? Indecision means you have something up and you just don't know if you're supposed to enter it, and you wait. And indecision is a similar term to procrastination, right? And I would define it Procrastination is waiting beyond the point you should have been waiting to. There's a certain point you maybe you're supposed to wait, and to the extent you'll go beyond that moment, whether it's 10 seconds as a day trade or 10 days as a long-term trade, you're procrastinating, and that can cost you more than just a little amount of money. It can cost you your whole career, because it's not a matter of just being late necessarily. It can take a good position and make it a bad position. So it comes from knowing what you're doing. It's obviously, I mean, you don't have to emphasize that. That's just, I don't have my little red dot here. Here it is. And traders battle indecisiveness with a set of tools called confirming indicators. And I kind of made all this up. I didn't copy this from anywhere, so it may not make sense to you. Which most of the time only greatly add to the indecision. And what that means is when people can't make up their mind what to do because they don't know what to do. I mean, obviously the answer is know what you're doing, but most people choose to say, no, I'm not going to figure out what I'm doing. I'm going to figure it out. I'll pretend. And when they come to indecision, they look to a bunch of external things to think that's the answer. Rather than addressing the problem, they go and find a bunch of other things, and we call them confirming indicators. You ever heard that term, anybody? Confirming indicator? Yes? No? Everybody? Ever heard that term? Confirming indicator. If you've been trading more than a month, or if you've been to any other presentation like this, you've probably heard it 7,200 times, right? There can be some value to a certain type of that, but for most people, they are a bad thing. I'll explain why, okay? Yeah, I'll read through a couple slides here real quick because it's just some words that don't really mean anything until they're backed up, right? So indecision comes from lack of confidence. When traders know what to do, the scale of indecisiveness is greatly minimized. I don't care how good you are, you're always going to hit this little moment where you're just not 100% sure. There's always that fine line. But that little scale, that little line is an eighth of an inch wide instead of being a quarter of a mile wide. If traders do not know what to do, they look for something to help them decide. It sounds smart, but it depends. If the thing that helps traders decide is part of the plan, and a proven method is good. Unfortunately, this is rarely the case. By the way, these are a couple of wordy slides where we're going to get into some charts and examples. There's actually a chart and a trade at the end. I know we all like that. This one is kind of devoid of those a little bit because it didn't make a lot of sense, but I threw one in here to make a point toward the end. I know we all like to see charts. Traders usually turn to one of the following. Now, what do I mean by turn, just so we're following? I'm saying when you're looking for a position, you're looking to pull the trigger, and you're just indecisive, you don't know. You're not sure. Should I get in now? Should I not get out? Should I wait? We turn to one of the following. Something subjective, something that correlates but does not cause it, something that confirms, wow, that's an overused word, and anything by selective perception that they want to use at that moment. And you know, it's not a big fancy term. I think you've all heard of it, but selective perception means that you basically listen to and let into your brain the things that agree with what your first thought was, you know, whatever it was, and you kind of block out anything that doesn't agree with you. So if you want to get out of a trade and, you know, somebody says, gee, there's a hurricane coming, you said, oh, bad news, better exit this trade, right? Or the market is falling. You know, I better get out of this day trade because the market's falling when it moved back 20 cents, you know, for the whole day. So let's talk about a couple of these. Let's go through, and we can't go through every single one of these, but let's take a look at a couple. Some subjective things. Subjective things. How about fundamentals? Now, we are not going to have a discussion about the value of fundamentals. That's not the point. Okay, I do that in other presentations. I'll be doing that this Friday at free seminar that you can all attend. But the question here is using this as an example of why a subjective things like fundamentals is bad, whether they work or not. That's not my point here. They don't, but that's not the point. The point is this, and I know most of you are probably not fundamental or would agree with me that they are. I think worthless is too strong a term, but you know, they're absorbed in the chart, so they are worthless to us as traders. But here's the thing: put yourself in the spot of a fundamental trader. Here's the question: you want to go long a stock with good fundamentals, right? When do you pull the trigger? And this is a serious question. I want to get some answers from some of you. And I know, you know, if you answer, I know it doesn't. I'm not thinking you're a fundamental trader. Don't be afraid. I'm going to bite your head off. Just pretend you're a fundamental trader, and answer for me. If you're a fundamental trader, when do you enter the trade? I mean, make up whatever you want to, but what? Just even give me an example. When do you enter a trade if you're a fundamental trader? What is the reproducible criteria? What is it that you do that if you enter this trade based on fundamentals this week, you could do the same thing next week. Or you could say in a few days, no, I goofed. That was the wrong, what? Something that says some things that you want to hear. So you're thinking going long stock XYZ, and somebody comes on the news and says, oh, I like XYZ, right? I mean, it's silly, but you're right. Well, actually, I'm going to talk about that Trader 8 in a little bit, but for right now, you're kind of avoiding the question because you're saying you wouldn't use technicals, or you wouldn't use fundamentals. But I mean, if you're a purely fundamental trader, again, forget the argument whether it's right or not. Just answer for me, please. When do you pull the trigger? Seriously, just really think about that because that gets to the heart of what I'm talking about today. And again, not just because it's fundamentals. I don't care about what we're talking about. The point is, think about it. Whatever you use, what makes you pull the trigger? What is it? Confirm the news, then enter trade? So you're saying, San Antonio, that you, as a fundamental trader, they would be going long on a news thing, right? That would be your trigger. You're following the stock, and all of a sudden one day somebody comes out and says, "Oh, I like this stock," and you get in after a week after earnings. So Paul's saying you let earnings come out. Any earnings report, Paul? I mean, at least Paul's getting me down the right alley to be objective. He's saying, okay, earnings a week later, but after good earnings or bad earnings? Do I want to go long on good earnings, Paul? Or do I want to go long? And it's a serious question because actually, most of the time, you probably want to go long on bad earnings a week later, right? Most of the time. Doesn't matter. So we just go long a week after earnings, we just go long. Well, that's at least that's easy criteria. At least I don't know if it works. See, there's always going to be two issues we're going to talk about, folks, and that's number one, do we have some objective concept, right? And then number two is going to be, does it work? So Paul has given me an objective concept to say, well, fundamentally, earnings come out, you wait 1 week and you go long. Well, okay, I mean, that is a very objective, clean concept. I could reproduce that anytime. I'm not sure it's a very good concept. I don't know that that would work at all, right? And Leo, you get into the concept of good earnings. Well, number one, you have to define what good is. And number two, if you look historically, Leo, you'll probably find that going long after good earnings most of the time it would be a huge mistake. So again, from both sides, I'm not sure if that makes sense from an actual what to do point of view. But even from the objective point of view, you'd have to kind of define what good earnings are, right? What's your criteria for what good earnings? Just beating last quarter, beating the number, beating the whisper number? Because as you know, you can have good earnings and the stock will get killed, right? You have to believe something. Well, yeah, that becomes very subjective, right? Earnings, yes, doesn't matter. Up, down, upgrades, downgrades. And as we know, Don, right? I mean, historically, most upgrades are done so that the person doing the upgrade can sell their stock. That really is true for the most part, right? So, again, you'd have to look and figure out if you feel that that is a viable trading strategy. But again, at least you have an objective criteria, right? And I know most of you are just giving me answers that I asked for. I know you're not believing this necessarily. But you see the point that we're at, right? Is to say, what does this mean? It's part of the problem of being a fundamental trader is you have no criteria to decide to get in or to get out for that matter, right? Yeah, Omar, you're asking me from a technical point of view, which I understand. But we're talking more, I think you maybe joined late. We're going through the concept of somebody who can't pull the trigger and we're deciding what causes this problem. And do you understand what I'm getting at, folks? This is like a problem. If this is how you enter a trade, you will always have a hard time pulling the trigger because you don't know what your criteria is to enter. Does that make sense what I'm saying? See, some of the stuff in my mind is so clear. And I'm told I'm pretty good at communicating this stuff, but I'm not always sure I'm getting the point across because to me it's crystal clear. But does this make sense? So that's the issue. There's no defined system to this, right? If you had a defined system, like Paul said, just go long a week after earnings, what would be a huge advantage to having a defined system, even if you're fundamental trading? What would be a huge advantage to that? I kind of already touched on it. It's a really important point. What is a huge, and again, if you're bored, it's not going to get a lot less boring. I warned you of that, but nothing to decide true, but there's another huge thing you can have if you have an objective system when to pull the trigger. Like I kind of alluded to with Paul's, excuse me, answer when Paul said go long a week after earnings. Whether we think that's good or bad or silly, what can we do about it? Right, Marco, exactly, is measurable. In other words, I can say to Paul, Paul, you're an idiot. Look at this. Here's 100 stocks long a week after earnings. Bam, 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 you got killed. Or Paul could say to me, look, hey, it really works. In other words, any one of us could reproduce that concept and see if it works or not, right? Now, we're walking a fine line here because anything that is purely objectively reproducible doesn't work. There does have to be some subjectivity involved, and that's why any kind of like indicators or any kind of a what we call a system of trading, where you say I'll go long over the high of the last 12 days, or the stop under the low of the last 4 days, anything like that some of you like to backtest. None of that will ever work. It can't. There has to be some subjectivity involved. But somewhere there you have to have, in your subjectivity, you have to have, at least in your mind, a very clear concept of what you did and why you did it. Otherwise, you get indecision. You don't know what to do. For example, I had this discussion with somebody a while ago. I'm going to ask you another question here in a minute, so get ready to answer. And his thing was, well, here's what I'm going to do, Paul. I take the IBD top 100. I don't know if that still exists or not. I think it does, but it's the 100 best rated fundamental stocks according to IBD. And he said, I'm going to use that as my universe, and then I'll enter at the appropriate time based on technical analysis. So does this make sense? Let me give you the answer so nobody sticks their head out there. It's okay in this case because all he is doing is he is eliminating a whole list of stocks he doesn't want to trade. See, it's always okay to eliminate something on a subjective concept. Yeah, the can slim thing, right? Yeah, right. This is what he wanted to do. But here's the funny thing. We had the conversation with him. I said, look, so you have this IBD list, right? And he was a little fuzzy with me what he was doing. So I said, if the IBD list did not give you the proper chart pattern, would you trade it? And he goes, no, absolutely not. Okay. I said, what if I showed you a chart pattern that was better than any chart pattern in your IBD 100, but it wasn't in the IBD 100? Would you trade it? And he goes, yes. So what do you think of that? He's going to trade the IBD 100, but if it's in the IBD 100 and it doesn't have a good chart, he's not going to trade it. But if he happened to run across a stock that had an incredible chart, even though it wasn't in the IBD, he would trade it. What do you think of that? Yeah, well, my question then is, why are you looking at the IBD period? You see, again, to him, it was a confirming indicator. Now, it's okay, right, Mark, because you're not going to get in trouble, right? In other words, all he's really done he's taken, let's say you would normally look at 1,000 stocks, right? He's taken 900 stocks and thrown them in the trash can, which is okay. I never have a problem with somebody who wants to eliminate a trade because you won't get in trouble. I have a problem with somebody who gets into a trade for the inappropriate reasons. But why do you want to throw out 900 stocks, right? Through the 1990s, most of the highest flying, best performing stocks would have never been on the IBD 100. Why? Because half of them didn't even have earnings. You go back and look at Google and Amazon and all these stocks, and they didn't even have earnings to start off with, right? So if your bottom line is, I'm looking at the chart, then why do we need to go and say, well, I'm going to look at the IBD 100 also? I mean, again, it just becomes a confusing, subjective, kind of confirming indicator. Yeah, again, all we want as a trader, whether you're holding it for 30 minutes or for 30 months, we want the stock to go up in price. That's what we want, right? We don't care why. A lot of stocks make their biggest moves before they even have earnings. I don't want to take long on this one. I just want to touch on this, that another thing people will do because they don't know what to do is to fall back and start looking at what other people are saying. Oh, I can't go long now. There's an inverted yield curve. And I heard on the news almost every minute of every day that there's a recession coming. Who says there's a recession coming, by the way, folks? Two questions. I'll make sure I don't want to live my... Two questions. Number one, I want to make sure I'm not living in my own little universe. Do you guys hear like every day there's a recession coming? Do you hear that? Yes or no? I just want to make sure I'm not like wacky or something. Oh, it's old news already? Oh, see, I'm so... Okay, so we hear that every day, right? But... Yeah, right, Mark, exactly. There's always one coming. It's like somebody saying the market's going to crash. You bet it is. Just most people are off by 5 years or so. So there's a recession coming, but who says there's a recession coming? Who is this? And you're right, Sky. I mean, in this case, I mean, again, I don't want to get into politics, so please don't get into politics. But in general, it's the media who probably has a different agenda right now, right, to say that. But if you talk to the Fed, who would be the, I guess, the source of the best news, they're saying there's no chance of a recession coming up. So, again, what are you looking at? What are you making your decisions on? I know this is a very vague talk through some of this, but I want to keep throwing you back to that morning and you say, okay, I need something for my long-term portfolio. I need something for a day trade. How do you find it? What do you look at? What do you throw out? What do you blank your mind to? See, I blank my mind to everything in the world except the chart and don't use confirming indicators. I'm going to put that in quotes. I mean, there's this fine line between what is the basis of what I do and what a confirming indicator is. But basically, I know what I want to do. I make my decision and I do it. I don't stop and say, oh, well, wait a minute, this is happening. In other words, anything that I would stop and say, wait a minute, it's part of my plan. It's part of what I do, right? If all of a sudden I said, well, wait a minute, the market just ran up to yesterday's high. Do I really want to go long? Well, that's part of my plan I look at. No, I wouldn't. But if all of a sudden the market ran down and I wanted to go long, I wouldn't say, oh, the guy in the news just said we have an inverted yield curve. You see the difference? By the way, I don't, you've heard me talk about it before. I don't mean to insult any economists. They say they're clueless. The economists say they're clueless, not me. They admit they're clueless. Nobody knows. And as you all know, the market, hopefully you know, the market leads the economy, not the other way around anyhow. Let me talk about this one too. Now this gets, again, I'm in this very gray area of talking about things that people look at. And this has become one of the ones to me that I just get this so much. I get this in charts. I get this from people that say, oh, Paul, boy, I'm using the VIX for my day trading, and it's so helpful. Oh, really? Okay, well, let's take a look. Now, first of all, we got to run through what the volatility index is. I want to go through this real quickly, and then I want to show you some charts, and I want to show you again how people get kind of tricked and fooled. And I want to make a couple of points real quick. The volatility index, which is the VIX, okay, is not subjective. It's a technical tool that brings new information to the table and can be very useful. Now, it is not a technical indicator, correct? Anybody with a high degree of technical knowledge? The VIX, the volatility index, is not a technical indicator. A technical indicator, by definition, is something that takes past history of prices and projects it forward. The volatility index brings us new information to the chart. The volatility, I'll tell you what it is in just a minute if you don't know. But the way many traders use the VXX is subjective or worthless. Now, the reason I put the VXX on here next to it is that because I, for a couple, 3 years, have not had the VIX. Just simply, the VIX is in a different quote package that you buy. And what I have has the VXX and not the VIX. I used to have the VIX up all the time and the VXX. I compared them, I've seen them. There is a very slight difference between the two. It's extremely technical what the difference is. But 80-85% of the time they're identical, and they both represent the volatility. Well, here's what the definition is, and again, I don't want to bore you with this, but just if you want to read it, it's the measure of expected price fluctuation. It's based on, it used to be based on 8 put and call prices of select stocks. Now it's based on the put and call price of the whole S&P 500. I don't know if a lot of you knew that. They changed that a few years back. Blah, blah, blah. Yeah, it's called the fear gauge, right? Exactly. It's a measurement of fear in the market because as the fear goes up, just generally speaking, as we start to fall, for example, traders are hedging or they're buying puts to offset long positions, and that is what increases the number that goes into the VIX, basically. Okay, so I'm going to use the first point I want to make is I'm going to use the VIX and VXX interchangeably because my charts have the VXX. But I want you to understand, and I don't want to be corrected, there is a little difference, but for all practical purposes, they're the same for my purpose right here, okay? And there's some more history about that if you care. Interesting too, I hadn't seen this room before. It's supposed to, I like the way they put that, predict stock price movement in the next following 30 days. Just give me a yes or no. How many of you are just familiar with VIX when I say VIX? Yes or no? I just want to know just kind of the level of who's out there listening. If I were to say, hey, to use the VIX. You would say, oh, volatility index, yeah, I know what that is, blah, blah. Okay, all right. So a lot of you had some experience or knowledge with it. So let me run through what I get all the time. And I tell you, I get this so much that every once in a while I have to sit back and think, is there something wrong with me? Am I losing it? Am I like wrong? I mean, can this many people be wrong and me be right? Well, the answer is yes, but yeah, well, yeah, they look the same, Everett. Again, if you go read about it, it's very technical how they're different. They are different, and the VXX is not the ETF or the VIX, which some people think, but it doesn't matter. So here's our job, and this is what I get all the time, guys. Here's our job. Yesterday afternoon, your job, go long at the bottom. So here's the QQQ. This is yesterday, right? This is snap this afternoon. So here's yesterday. And let's say your job was you felt that we made a bottom here and we're falling and you want to get that higher low. So you want to go long as soon as you possibly can off that bottom, right? So again, we don't know it's going to form, right? We're falling. So if it forms, naturally we can wait for the QQ chart to form, but it could fail. And is there a way to get in earlier? How about this? And I want you guys to tell me what you think of this. Now this is the QQQ, right? Now the exact same time frame, the exact same chart, here's the VXX, right? Which is inverse, right? It's kind of doing the opposite thing. You say, hey, Paul, here's all you have to do. Here's what I do. I pull out the VXX. And when the VXX does the sell setup, I know it's time to go long. What do we think about that? What do we think about that? Good plan? Wow. I mean, it's a incredible tool to say, boy, when that fear tops out, we know the fear will drop and then the market's going to go up, right? I cannot tell you how many times I've had this discussion in the last decade. I cannot tell you how many times. It's amazing to me too, while I'm waiting for answers here. Well, how do you know when it peaks? How do you know when it peaks more? I mean, that's the peak. When you're down here, right, that was the peak. But what if you're here? What if it went up a little more? When it starts going down? Well, it started to go down here. Look at more right there. See that bottoming tail? That was a big red bar at one point. There's another big red bar. So it was starting to go down several times. I mean, how do we know this is the one? Here's a little more information for you, just for fun. Go to this moment in time, right there, on the 1 minute chart. Okay? So that moment right there, on the 1 minute chart, here's the VIX. VIX 1 minute chart. The high, so the high on that 15-minute chart, if you come down to 1 minute chart, was at the minute ending 1452 right there. Okay? So the plan is, of course, that when we see that VXX top out, that is our incredible tool to know to go long. Whoops, I didn't mean to change that yet, sorry. The market, right? That's the plan. Isn't that the plan of this, right? So here's the QQQ, and just remember this number here. That high was at 1452. So here's the QQQ, and here's the 1 minute chart of the QQQ, right? So I guess if I wanted to go long, I would wait for that VXX to tell me it's time to go long, right? But guess what? The VXX, the QQQ, 1443. It bottomed 9 minutes before the VIX did, before the VIX topped. And just this whole concept. I mean, here's the 15-minute chart. Just keep this simple. Why is it easier to determine when that's a sell setup than it is to determine when that's a buy setup? Could you answer me that question? You're right. The VXX, the VIX does not lead. When the market goes up, the VIX goes down. When the market goes down, the VIX goes up. They're lockstep. Maybe some moments one's a minute or two ahead, but it's random. Does everybody see my point here? Does everybody see the point? This is not a unique chart. Matter of fact, I went back to yesterday and took the first 15-minute buy or sell setup that I saw. I've been looking at this for years. I'm very familiar with the VIX. But do you see my point? Now, some of you are probably saying, what's your point? I would never do that. Well, I can't tell you how many people use this. So why are we using it? See, it's the point of today. Why are we using the VXX or the VIX at times when it simply doesn't matter? Why? Because it's a quote unquote, it's a confirming indicator. It's something else to look at. It's something else to throw in the pot when you just don't really know what you're doing, right? It is. It is. There's nothing easier about, like Maura, right? You said, when it starts going down. Well, it's a tricky thing to tell, right? But the point is there's no easier job. Well, let me ask you this, let me ask you this. Is it any easier to tell when the VIX rolls over and forms a top? Is that any easier than telling when the market formed a bottom? No. So why do we have this crap on our chart looking at us? If you go back and look at my bookmark on the market, the VIX is one of the things I looked at for the last big turning point a long time ago. The VIX can be useful in two occasions, and Charles kind of mentioned one of them. Number one, you will be teaching me something if you tell me how to use it intraday. I think it's worthless intraday. By definition, it's worthless intraday. It's not even meant to project anything intraday. It's just a reflection. It's a mirror image of what the market's doing. On a longer term chart, the two uses for it people never use. Number one is complacency. Do you know what complacency is? It means that if the market is falling and the VIX is not rising at the proportionate rate when you're near a market top, that's complacency. That gives you a little clue sometimes. That's some good information. And extreme, not divergence, but complacency would be a form of divergence, but in extreme overextended move. So when the market is maybe bottoming, the VIX makes an extremely sharper higher top. Exactly, Everett. Exactly. Yeah, I think I actually said that. But if you cannot tell me exactly what it does for you, why do you have it on your screen? Because it's just another thing that adds to indecision. Because people call it a confirming indicator. There's nothing useful about it at all. And I've said this to so many people over the years, and I'm waiting for anybody to prove me wrong. Now, again, understand, I'm talking about using it for what I just showed you here, when it's doing a mirror image of what the market's doing. There's no added benefit. And again, the point of this talk today is not even about learning what the VIX is, It's to say, what are you basing your decisions on? And most people start turning to stuff like this because they don't know what to base their decisions on. What do you base your decisions on? Somebody should be asking me about this point. Just extremely good technical analysis that you know and understand, because it really, really works. I'll show you an example in a second. So I have a nickel on here somewhere. There we go. If I had a nickel for every time I had this conversation with somebody. Summary slide on the VX real quick. Hey, Joe, thanks. I'll tell you about it in just a minute. VIX has a purpose, do not get me wrong, and is not a technical indicator. It brings new information to the table, but it is not for what I just showed you. The way many traders use the VIX is subjective and worthless. Before I kind of sum this up, let me go to one other thing, and then we're going to go to a chart, and I want to make my final points here. And again, I apologize that this is maybe, I said it right in the email, this is maybe a little esoteric. I think any time that I really hit home with a handful of you, I've done my job. I know not everyone gets the same thing out of all of this, but I think this is really a bigger topic than most people realize. It's one of those little silent killers where you have to step up to the table one day and say, hey, I need to know exactly what I'm supposed to be doing, not just taking all these random trades, so to speak. Here's a slide too that I believe very much in general about indecision. Well, thank you, Charles. Thanks. This is a quote from a book called Think and Grow Rich. I remember this quote, and I went and looked it up to copy and paste it. And I imagine some of you have heard of the book. It's a fairly popular book. Successful people make decisions quickly, as soon as all the facts are available, and change them very slowly, if ever. Unsuccessful people make decisions very slowly and change them often very quickly. I think that's one of the truest things out there. I mean, not just in trading. I think it applies incredibly well to trading. And you may say, well, wait a minute, Paul. Quick decisions, isn't that reckless in trading? You tell me. Making a quick decision in trading, is that reckless? If you say no, why not? Right, see, that's the whole thing, is because, and here's the key to this, folks. Right, Glenn, man, you just nailed it. You took all the wind out of my sails. See, you are making your decisions before you ever go hunting for your stock, right? You've made your decision what you need to find, and when you find it, boom, there it is. And once you find it, you've made your decision ahead of time what your entry is, and boom, there it is. Even on a long-term position, I've taken 3 long-term positions in the last couple of weeks, and they came from a list. Well, you guys that are with me Monday night sometimes, you see what I do. I have a weekly chart and monthly chart, bullish and bearish lists, and I update them periodically depending upon how aggressive I want to be and how much the market is changing. And I make out of those a hot list every other day. And when I say the timing is right and the market, I look, and I make my decision in a second, just literally. Kimberly Clark, KMB, was the last long-term position I took. It was a short. And actually it's the same day with ATVI long, opposite directions, unique stocks. And I went looking for something, I went hunting for something, and boom, KMB instantly was it. Just went and looked for the numbers. Nothing to think about. It's not because it's reckless, it's because everything that I wanted to know, I had already decided ahead of time, right? What should the daily and weekly chart look like? Here, I do have charts loaded up here, so I can switch over real quick. Screen sharing, you got charts up? Kimberly Clark, 5 days ago, go back 5 days, boom, right? I felt it was time to have a short because of where the market was, what the market was doing, right? And I had this on a chart for, on my list for, you guys are with me Monday night. This has been on the list for, I don't know, a month, 2 months. It's been on the list a long time. Why? Well, let's make this a monthly chart. Because it came up on a long run to retest this area up in here. Now, it doesn't matter to overshot it a little bit. What matters is daily chart, boom, big red bar, retest, boom. So this is where I want to short stuff. I explained that to you. I want to short them just coming off high. So I got in right up here somewhere, and it dropped. But again, the decision was based on my technical knowledge, what I want to do, when I want to do it, my technical entries. It's all, cookie cutter, pre-planned, pre-formatted in my head. When I went to do that, it had nothing to do with China. It had nothing to do with inverted, preverted, or diverted yield curves. It had nothing to do with, I'm not even real sure what Kimberly Clark does. Do they make toilet paper? Is that the paper company? Right? They're the paper company, right? I'm not being funny. I actually don't know. Kimberly Clark's paper, right? Paper towels, toilet paper, diapers, and diapers. Paper stuff, okay. So I know what they are from just being a human being, but I didn't look up what they did. I didn't look up the last earnings. I didn't look up their fundamentals. I don't know what their P ratio is. I don't know what their bill to book ratio is. I don't know any of that stuff. Here's all I know, right here, this chart. You could even erase the name up here. I wouldn't care. KMB, a lot of times I don't even know what the stock name is that I'm trading. I don't even know. I just know the 3-digit symbol. I know some of you think that's probably way out there wacky. Well, after 2 decades of doing this, I have to tell you, I think any other way is wacky. Just the reverse. Why? We talked about it. Notes. Just wanted to make it clear, we kind of talked about this, but it says up here in this little quote, as soon as all the facts are available. Well, when we're trading, the facts are the chart. The facts are the chart, and they're available instantaneously, right? And one other point I want to make on this slide, and let me address more. I'm not sure of the purpose of your comment. Are you saying that everyone, or are you saying that people can trade fundamentals and be successful? See, there's a line here again. Yes, I do what works for me, and yes, everyone in a sense has to do what works for them. I'm the first one to say there's a zillion ways to make money in the market if you're in the right group of ways. But there are things that are wrong. You will never make money looking at fundamentals. You will never make money understanding the economy. Okay, those things are wrong. Now, you could coincidentally make money. Sometimes people think that they're doing the right thing because we're in a bull market, and whatever they're listening to, the news, the economy, it gets them bullish, so they go long. But when things diverge, they lose money because, well, they said the economy is doing bad now, so I shorted, and the market's still going up. Something's wrong. So as long as we're understanding that a chart truly does encompass everything that's out there, there is nothing else to look at. And again, it's not that these other things are wrong. It's just that they're all built into the chart. I'm going to keep coming back to a line that I did in a presentation 2 times ago, including this one 3 times ago. And the basic gist of the line was this, is that most people look at the price of the stock and then they look at news, economy, fundamentals, and they say, you know what? That price is wrong. The price of stock XYZ is $30. And I've just looked at the fundamentals, and I've looked at the news, and I've looked at the economy, and I've determined what the trade deal with China is, and I am smarter than the rest of the world, and I think that stock's going up. Now, there are a few people that can do that, but 99.999% chance none of you can do that. And my attitude is this: I'm not smarter than the rest of the world. I'm stupider than everyone else out there. But you know what I want to do? I'm just going to follow the people who at least think they're smart. I don't know if they're smart or not. I don't really care. But if they have a ton of money and if they want to move the stock up 10 points, I'll tag along with them. Does that make sense, everyone? Because when you think about it, any other thing but what I'm telling you means that you are saying that the price is wrong and you're right if you use any of the other stuff, right? And then, of course, following the big boys, that's what technical analysis is. And, of course, it's not quite as simple as it sounds. It's a little, a little more difficult. Let me give you one other thing on here, too, about procrastinating. You know that being, even if you make your decision, if you base it on a concept that you have tested and like and you know what you're doing, being wrong is better than always being late. Because if you procrastinate too much, you never make money, right? Because the good trades get watered down. And remember, I showed you, I haven't done this in a while, but I explained that being late to a trade is not as simple as just losing some of the profit. It often screws you up because you end up getting out of a trade because you didn't hit your target the way you should have, or you expected too much. In other words, it can take a winning trade into a losing trade. And I don't want to go through it again, but do all of you agree with that? That entering late can take a winning trade and make it a losing trade. It's not just a matter of losing some of the profit. That's what everybody thinks is, oh, I'm late, I'll lose some profit. I've done this many times, and I just want to kick myself. I want to, I always say take that number 2 pencil, sharpen it to a point, and shove it into my cornea. That's what I always say. Anytime I do that, I just want to just kick myself. It's not, being late is not a matter of losing some of the profit. It turns the trade on its head where you can totally lose money, and that's where you have to be careful of some of this stuff. So making a decision at the perfect moment, even when you're wrong sometimes, is better than always being late. Does that make sense, guys? But to make that decision at the perfect moment, you have to be on top of your game. You have to know what you're doing, right? There's a chart coming up in a couple of minutes. Perfection. Perfection can cost you money. I am a borderline perfectionist. You may have determined that from listening to me. And I don't say that in a complimentary manner. Anybody out there consider themselves a borderline perfectionist? Anybody? Because it's a bad thing. It really is. It's a bad thing. It's something I have to fight. I consider it a bad thing. Nobody wants to admit to being a borderline. Just got over it. See, because what happens is doing X, you get 95% of the result. And then a perfectionist takes 50% of that time again to get the last 5%. Which doesn't make any sense unless your goal has to be 100%. You see what I'm saying? And I'm not sure this is not totally on point here, but perfection can cost you money. You can't have everything in the stars line up. And this is what I call, some of you who trade with me know, I call it moment in time trading. It means that this is the moment where the whole world is going to turn. Either the stock is going to crash from here or not, but this is the moment I get in. And no, it's not all perfect. And yes, if it doesn't work, I could go back and tell you why it didn't work. But who cares? I'd rather not miss the trade. Does that make sense? There's a saying out there, miss money is better than lost money. I'm sure you all heard it before. I've even probably said it, but I do not like it at all. It's said to new traders because they often overtrade without standards, so it kind of makes sense to new traders. But as an experienced trader, it's not okay to miss your best trade. Your miss can cost you more than the loss. And that's not a typo. I put lost because that's what the saying says. Missed money is better than lost money. So your miss can cost you more than your loss. Does that make sense for everyone also? Now, when you're new, that might not make a lot of sense to you. Here's one of the big peeves I have also, is that so many traders have been trained differently when they're new. It's like, oh, you're a new trader, so we're going to do this. Here's how you trail stop something. You go really tight so you protect your profit. It's all wrong. It's all wrong. You should not do anything different as a brand new trader than the most experienced trader. In other words, when I train traders, I trade them to the nth level. I train you for what you should be doing after 10 years of trading on day one. What's the one thing that changes when you're a brand new trader? What's the one thing that changes? It is the catch-all that saves everything. What is the one net, the safety net that changes as a brand new trader? There's only one thing a brand new trader should do differently than an experienced trader when they're learning. You shouldn't change. Do you guys, well, let's start with what the one thing is first. Right, exactly. Share size. You should be trading nothing initially and then $5. And that is your total safety net. See, why do you start off trading small size? And then in addition to that, well, you're a new trader. Let's use a different method of trailing. Let's use a different method of entry. Let's use a different this, a different that. Let's come up with the expression, missed money is better than lost money. No, you don't do everything, because who comes around and straightens you out then when you start making money? Do you understand what I'm saying? New traders are so often taught, see, because the theory is that new traders are going to lose. Let's teach them to preserve profits. Let's teach them to minimize losses. Let's teach them that missed money is better than lost money. It's all crap. It's all wrong. Does that make sense to any of you at all? You go in and you get trained like the best shark in the tank. It's just, here's what we do. To protect you, use a little tiny risk amount until you know what you're doing. Does that make sense, everyone? It's one of the bigger things I have to deal with, is that so many people get trained kind of the wrong way. You don't trade differently because you're new. You trade all out, you know what, to the wall. You just cut the share size down to nothing until you can prove you know what you're doing. Boom. All right. Be decisive. Just a quick example, and we're going to be done. And this is from today. And again, I didn't have any charts there. I thought, this is the last minute. I thought, you know what? Let me just show them what I'm talking about, okay? Exactly, Jackson. You just keep adding those zeros. Start off risking $10. Well, don't go to 100. Go 10, 20, 50, 100, whatever. You figure it out. Be decisive. Here's today. Here's a chart. Doesn't even matter what it is. It's General Motors, but who cares? Here's the daily chart. Who cares? Daily chart rallied into some area. Here's the hourly chart. That does make a big difference. When I'm day trading, the hourly chart is the king chart. It's the queen. The queen chart, excuse me, I should say. The queen is more important, right, ladies? Here's the queen chart, the hourly chart. That was before the trading day today. Here is the 2-minute chart. This stock gapped down and it ran like a banshee straight up. Huge green bar on the 2-minute chart. What do you do with this? Go long on a pullback, short this now, wait for confirmation to short it. What do you do? 60-minute chart, we gapped down to right here, ran back up. Here it is, 2-minute chart, gap down here, we ran back up. This is the chart after 2 minutes of trading. The rest is covered up. I'll show it to you in a minute. We ran up like a banshee for 2 minutes. Big move up. And of course, this high right here would be that high right there. The hourly chart and the 2-minute chart are covered up. What do you do with it? Well, you can flip. What do you mean flip? I'm not in it, so there's nothing to flip. Oh, my answer is going to be, doesn't matter what you say. What you would do with it is nothing unless this was a stock that you picked out, that you selected because you know what to do with it. This is one of my favorite trades. This is one of my favorite trades. And this is kind of what somebody said a while ago, what do you do? To me, see, this chart was, well, actually, in all fairness, I think, oh no, today I had this one out there too. There's Ford in this one. And this is a favorite thing to me. I mean, the strategy, the daily chart is not really relevant here. The hourly chart is called a retest and failure. And well, actually, at this point, it's more of a major resistance area. So we gap down beneath that area, and we use all of our juice just to get back up to the prior high. So I short it. Boom, I just short it. And that's my point, is this happened the first minute of the day. I know this is a 2-minute bar, but I actually caught it right off the high. It only comes down to knowing exactly what to do. You have to have the knowledge, and then you have to have the mindset. So it's not just having the knowledge to say, here's a chart I want to keep on my screen. And I didn't know I'd be trading this. When it gapped down, when I saw it run up, that's when I brought it front and center. I said, okay, here it is running back up into this area. This is my favorite trade. Does it always work? No. But you know when I short it? I short it right there, just right there. Decisive. Get in and make your money if you're right. If you're not right, you're going to stop out either way. So you have to have the mindset. So you have to, it's not just a matter of saying, I like this chart. It's a matter of saying, okay, when this stock, and usually in the room, right, in the room, guys, didn't I say today, once it gets over XXX, I'm going to start stalking it short, right? I know the number. I say it, boom, and there it is. Instant decision, right? Boom, and here's how you get rewarded. Boom, target one, because I got in up here, because I got in up here, and the numbers are here, boom, at 39.43. So that's a dime off the high of the day. That's a nice target. So there's target one down there, and then the back half I took out at lunch, which was a nicer target. No, they don't all work, but waiting for anything else on this could have led to just losses, could have led to no profit or whatever. Now there's another good entry here. You could have done it here as well. It would have worked okay. That's a pattern I was fine with. That's where I lowered my stop on the back half. So number one, you have to have a clear understanding of what you want to do. And for me, for anybody, if you don't believe this, you should never tune in and listen to me again. Technical analysis is the only way that you make money. For any of you listening to me, for any of you listening to me, if you're one of the 0.001% that has some special skill, knowledge, whatever it is, great. But for the vast majority of us, we don't. I had to embrace the stop outs as part of it to get ahead. Well, that's true, Mark. And sometimes I've had a lot of people say to me when I teach class, I put a lot of little blurbs in there, and I've had a lot of people say to me that I said a sentence to them and it changed them. So here's my sentence for you, and maybe you've heard me say it before, maybe you don't like it at all, but what you have to understand is that stop outs are not failures. Stop outs are an integral part of a winning trading plan, right? You can't be afraid of them. You have to say, hey, not everything is going to work. If you're trying to trade so that everything always works, you'll never make money. You can't. There has to be some risk involved. Without risk, there's no reward. There has to be some risk involved. There's no such thing as a free lunch, as a safe bet. There's none of that. It only comes from superior knowledge and knowing that, hey, if you got it wrong, you need to get out at some point, right? You don't want the loss to build into something that's going to be a detriment to you for the day or for the month, right? Right, Marinus. Hey, Marinus. That's Marinus typed that in there. Marinus is in the room with me because he emailed me. That's a line that I said to him that's in the seminars that he came to love, right, Marinus? You said that. See, I remember you said that to me in an email. You came to love that line that I said to you. It helped you, figure out some of the stuff. Marinus is in the room. Took seminar program, doing well. All right. Any questions? We're actually done exactly on time to the second. That's amazing. Does anybody have any questions or anything you want to ask me or talk about? Well, those of you in the trading room, I'll see you tomorrow. And those of you that are going to be taking the seminar program, I'll see you Saturday. And I'm sorry, I'll see all of you on Friday, I guess, right? See you guys Friday for the half day class. All right. Thanks, guys. Have a good rest of the evening.